Hi and welcome to today's special episode. Today we are going to break down one of the simplest but most powerful tools in investing, market indices. We're going to talk about how they can simplify investing, provide natural diversification, and help you align your portfolio with global economic trends and major themes of the moment. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Often, when we talk about the market, we're actually referring to an index. Simply put, an index is a basket of stocks designed to represent a market or a segment of the market. So instead of tracking a single company, an index tracks the performance of many companies put together at once. For example, the S&P 500, the most popular index in the world, tracks 500 of the largest publicly traded companies in the United States. The FTSE 100 tracks the 100 largest companies listed in London. In Europe, the Stoxx 600 index gives a broad picture of the European equity markets, but investors can also look more closely into the region. In the sense, the DAX tracks, for example, the largest publicly traded companies in Germany, 30 of them. The CAC 40 tracks the 40 largest publicly traded companies in France, and the IBEX 35 represents Spain's 35 biggest listed firms. Then there are broader regional and global benchmarks such as the MSCI Asia x Japan, for example, MSCI World x USA, or the global MSCI World Index. All of these indices represent different markets across the globe. Now, indices are not just statistical tools. Over the past 2 decades, they have also become one of the easiest ways for investors to gain exposure to financial markets. Now, for investors who don't want to spend time analyzing each individual company out there, well, this is indeed a major advantage, because instead of trying to pick the next winning stock, well, investors can simply buy the market. And that approach offers a very important benefit, which is natural diversification. Because obviously, when you invest in an index, your investment is spread across many companies, many sectors, and sometimes even many countries. And that means that if one company performs poorly, for example, the impact on the overall index is usually limited. So this diversification is one of the reasons index investing has become so popular among investors. And on top of diversification, market indices also have another powerful feature: they constantly evolve. The companies inside them are regularly reviewed. Firms that grow and succeed gain more weight in the index or enter the index, while those that shrink, underperform, or disappear are eventually removed or replaced in the index. So that means that over time, indices tend to reflect the strongest and most relevant companies in the economy, in that market, no matter which companies we are talking about on the individual level. Technology companies, for example, barely appeared in major US equity benchmarks 30 years ago. The US indices were instead dominated by big energy companies. Today, the Magnificent Seven stocks, all technology companies, make up to around a third of the S&P 500's capital weighted index. So this constant renewal means that, in a way, index investors are always exposed to the most dynamic parts of the market that they invest in. And combined with diversification, this makes index investing a very powerful long-term approach. Now, indices are designed the same. They include many companies, but they are not all the same, because each one reflects the structure of the economy it represents. And economies are not identical, of course. We already talked about how the US major indices like the S&P 500, for example, are heavy in technology companies, but elsewhere, take the FTSE 100, for example. Despite being the main UK index, the FTSE 100 index is surprisingly global and commodity heavy. It includes large mining groups, oil majors, and major banks. Companies like Rio Tinto, BP, and HSBC have significant weight in this index, making the UK's blue chip index extremely sensitive to global trends and the US dollar, for example. As a result, the FTSE 100 often performs well when commodity prices rise or when global demand for raw materials is strong. Across the channel, Europe's STOXX 600 index has a different profile. This index includes many industrial companies across mainland Europe, banks and exporters that are closely tied to the global economic cycle as well. And within Europe, each market has its own characteristics and they're very different. Germany's DAX, for example, is heavily weighted toward industrials, automotive and chemicals. The French CAC 40, on the other hand, includes several luxury companies that are very sensitive to consumer spending trends abroad, particularly in the US and in China. And Switzerland's SMI index is well known for its large healthcare, consumer staples, and pharmaceutical companies, while in Asia, for example, South Korea's Kospi index is heavily weighted toward technology and export-driven firms and is home to some of the world's biggest memory chip manufacturers. So as you see, the indices are very different from each other, and this is exactly why market indices are especially interesting for investors, because different indices tend to perform better at different stages of an economic cycle. For example, when global financial conditions tighten, when interest rates are high or they are expected to rise and economic uncertainty increases, well, investors around the world often rotate toward defensive sectors. Defensive companies typically sell essential goods and services that people around the world will continue to buy, and that regardless of economic conditions. So indices with a higher share of these defensive companies, for example, tend to be more resilient during economic slowdown periods. On the other hand, when economic growth accelerates across the globe and demand strengthens, cyclical sectors often outperform. Cyclical companies are those whose revenues are closely tied to the business cycle, like industrials, banks, construction firms, and commodity producers, for example. And that's when indices with stronger exposure to these sectors, such as many European markets, for example, can outperform the rest. Then, of course, it's not all the time about economic cycles. There are other themes than the economic cycles out there. There are green energy, AI, geopolitics, many of them, and they also lead to divergent performances on index levels among different indices that represent different markets around the world and that do have different risk exposures and that do not react in the same way to what's happening around the world to these different themes. One of the most striking examples for this is that over the past years, despite rising inflation, despite tighter financial conditions, and despite higher global yields following the pandemic and the war in Ukraine, well, S&P 500 rallied strongly on enthusiasm around artificial intelligence and it outperformed most European indices big time. But right after that, the rotation trade came in play where European indices outperformed their US peers. So it's not about which market index is better, but what's the best timing for choosing one market index over the others. Now, while choosing which market to track can actually be a very powerful way to express a view on the global economic cycle and also build a trading or an investment strategy that is quite powerful and fruitful to investors. So how can investors actually invest in these market indices? Well, the most common way is through exchange-traded funds, also called ETFs and futures. So these ETFs are exchange-traded funds, again, that allow investors to build exposure to an index with a single trade, while futures are derivative contracts whose value follows the performance of an underlying index. Instead of buying the companies in the index directly, investors trade a contract that reflects the expected value of that index at a specific date in the future. Now, what's great with futures is that they're extremely liquid and they can be traded almost around the clock. That makes them very useful for reacting quickly to market news, for example, or macroeconomic events. Plus, futures also allow investors to gain large exposure to an index with a relatively small amount of capital. That's thanks to leverage. Leverage traders only need to post a margin deposit rather than pay the full value of the exposure. So this makes futures a very powerful and popular tool for short-term trading, but also hedging portfolios and quickly adjusting market exposure. However, note that leverage also means that futures carry higher risk when leveraged. Speaking of risk, there are also leverage and inverse products that allow investors to amplify gains or bet on a market decline. These instruments exist through ETFs, but they significantly increase risk and are generally designed for short-term trading rather than long-term investing. I thought it was important to highlight that point. So in summary, indices are an excellent way for investors to gain exposure to broad markets, diversify their portfolios, and access different sectors and regions without selecting individual stocks. And because indices continuously evolve, removing weaker companies and incorporating stronger ones, they also tend to reflect the most dynamic parts of the market over time. And that, combined with natural diversification, makes index investing a powerful foundation for many investors, especially if you are new to the investing world. So this is all for this episode on market indices. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this educative episode on indices has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. As usual, follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you soon, and until then, goodbye.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.